Welcome to our deep dive into emerging market strategies. Today, we'll explore the vast opportunities and unique challenges of doing business in fast-growing economies such as Southeast Asia, Latin America, and Sub-Saharan Africa. These regions are capturing global attention due to their rapid economic growth, expanding consumer bases, and increasing integration into the world economy. However, entering these markets is not without its hurdles. From regulatory complexities to cultural nuances, companies must navigate a dynamic landscape. Let's start by understanding what makes these markets so attractive and why they're on every business leader's radar. Emerging markets are countries experiencing rapid economic development and industrialization. Unlike developed economies, these markets are characterized by evolving financial systems, growing middle classes, and significant infrastructure investments. Examples include Indonesia, Brazil, Nigeria, and Vietnam. Their economies are often more volatile but offer higher growth potential. Understanding the definition and scope of emerging markets is crucial for businesses aiming to expand globally. Let's look at the key features that set these markets apart from their developed counterparts. Why are companies so eager to enter emerging markets? The answer lies in their untapped potential. These regions boast large youthful populations and rising incomes, fueling demand for goods and services. As traditional markets become saturated, businesses look to emerging economies for new growth avenues. Additionally, governments in these regions often encourage foreign investment, offering incentives and infrastructure support. However, the promise of high returns comes with increased risk. Let's explore the main opportunities that attract global businesses. One of the biggest draws of emerging markets is their sheer size and growth potential. Countries like India and Brazil have populations exceeding hundreds of millions, with urbanization driving new consumption patterns. As more people move to cities and join the workforce, demand for products and services surges. This creates fertile ground for businesses to introduce innovative offerings and capture market share. But tapping into this potential requires a deep understanding of local preferences and trends. Expanding middle class is a hallmark of emerging markets. As incomes rise, millions of people gain access to better education, healthcare, and consumer goods. This shift transforms societies and creates new opportunities for businesses across sectors, from retail to technology. Companies that can adapt their products to meet the needs of this growing demographic stand to gain a significant competitive advantage. Let's examine how the middle class is reshaping consumption patterns in these regions. Emerging markets are investing heavily in infrastructure, roads, ports, telecommunications, and energy. These improvements not only boost economic productivity, but also make it easier for businesses to operate efficiently. For example, better transportation networks reduce logistics costs and open up rural areas to new products. Infrastructure development is often supported by public-private partnerships, creating opportunities for foreign investors and service providers. However, infrastructure gaps still exist, and companies must plan for potential bottlenecks. Digital transformation is sweeping across emerging markets. Mobile technology and internet access are connecting millions to the global economy for the first time. E-commerce, digital payments, and social media are rapidly changing how people shop, communicate, and do business. For companies, that means new channels for reaching customers and streamlining operations. However, digital divides persist, and businesses must tailor their strategies to local levels of technology adoption. Navigating the regulatory environment is a major challenge in emerging markets. Laws and regulations can change rapidly, and enforcement may be inconsistent. Companies must stay informed about local business practices, tax policies, and compliance requirements. Building strong relationships with local authorities and partners is essential for managing risk. Regulatory uncertainty can be daunting, but with the right approach, it's possible to turn challenges into opportunity. Political and economic risks are inherent in emerging markets. Governments may change policies unexpectedly, and economic volatility can impact business operations. Currency fluctuations, inflation, and political instability are common concerns. Companies must develop robust risk management strategies, including scenario planning and diversification. Understanding the local political landscape and maintaining flexibility are key to long-term success. Cultural understanding is critical when doing business in emerging markets. Each region has its own customs, communication styles, and business etiquette. For example, relationship building is often more important than formal contracts in many Southeast Asian and Latin American countries. Companies that invest in cultural training and local talent are better equipped to build trust and avoid misunderstandings. Let's see how cultural awareness can drive business success. Access to skilled talent is both an opportunity and a challenge in emerging markets. While there is a large young workforce, skill gaps can exist in areas such as technology and management. Companies often invest in training and development to build local capabilities. Partnering with local educational institutions and offering career advancement opportunities can help attract and retain top talent. Building a strong workforce is essential for sustainable growth. Forming local partnerships is a proven strategy for success in emerging markets. Local partners bring valuable market knowledge, networks, and credibility. Joint ventures, strategic alliances, and distributor agreements can help foreign companies navigate regulatory hurdles and cultural differences. Choosing the right partner is crucial, so due diligence and clear agreements are essential. Let's explore how partnerships can accelerate market entry and growth. Success in emerging markets often requires adapting products and services to local needs. This could mean adjusting pricing, packaging, or features to suit different consumer preferences and purchasing power. Companies that listen to local customers and innovate accordingly are more likely to win loyalty and market share. Flexibility and responsiveness are key traits for thriving in these dynamic environments. Efficient distribution and logistics are vital for reaching customers in emerging markets. Infrastructure gaps, fragmented retail channels, and challenging geography can complicate supply chains. Companies must develop creative solutions, such as partnering with local distributors or leveraging digital platforms for last-mile delivery. investing in logistics capabilities can provide a significant competitive edge. Access to financing and reliable payment systems is a common challenge in emerging markets. Traditional banking infrastructure may be limited, especially in rural areas. However, mobile banking and fintech solutions are bridging the gap, enabling more people to participate in the formal economy. Companies must offer flexible payment options and manage currency risks to succeed in these environments. Building a strong brand is essential for standing out in crowded emerging markets. Effective marketing strategies must resonate with local values, languages, and media habits. Social media and influencer marketing are particularly powerful in regions with high mobile usage. Companies that invest in brand building can create lasting customer loyalty and drive long-term growth. Sustainability and social responsibility are increasingly important in emerging markets. Consumers and governments expect businesses to contribute positively to society and the environment. Companies that invest in sustainable practices, such as reducing waste or supporting local communities, can enhance their reputation and build trust. Social impact initiatives can also open new markets and drive innovation. Let's take a closer look at Southeast Asia. This region is home to over 650 million people and some of the world's fastest-growing economies. Countries like Vietnam, Indonesia, and the Philippines are attracting foreign investment with their young populations and digital adoption. However, the region's diversity means that strategies must be tailored to each market. Understanding local regulations, languages, and consumer preferences is key to success. Latin America offers vast opportunities, especially in sectors like agriculture, energy, and technology. Brazil and Mexico are regional powerhouses, while countries like Colombia and Chile are emerging as innovation hubs. However, political instability and regulatory complexity can pose challenges. Companies that succeed here often build strong local teams and adapt quickly to changing conditions. Sub-Saharan Africa is a region of immense potential and diversity. With a population exceeding 1 billion, it offers opportunities in sectors like fintech, agriculture, and consumer goods. Mobile technology is transforming access to financial services and information. However, infrastructure gaps and political risks require careful planning. Companies that invest in local partnerships and community engagement often find long-term success. Innovation is thriving in emerging markets, often out of necessity. Companies develop creative solutions to address local challenges such as affordable healthcare or off-grid energy. These innovations can become models for other markets, a phenomenon known as reverse innovation. Businesses that embrace local ingenuity can gain a competitive edge and drive global impact. Governments play a crucial role in shaping the business environment in emerging markets. Policies on trade, investment, and regulation can either attract or deter foreign companies. Engaging with policymakers and understanding the regulatory landscape is essential for long-term success. Companies should also monitor policy changes and participate in industry associations to stay informed. Corruption and ethical challenges can be significant obstacles in some emerging markets. Companies must establish strong compliance programs and foster a culture of integrity. Transparent operations and zero-tolerance policies help build trust with stakeholders and avoid legal issues. Partnering with reputable local organizations can also mitigate risks. Protecting intellectual property (IP) can be challenging in emerging markets where enforcement may be weak. Companies should register their IP locally and work with legal experts to safeguard their innovations. Educating local partners and employees about IP rights is also important. Proactive measures can prevent costly disputes and protect competitive advantages. Building resilient supply chains is essential for operating in emerging markets. Disruptions from political events, natural disasters, or infrastructure failures can impact business continuity. Companies should diversify suppliers, invest in local sourcing, and develop contingency plans. Technology can also enhance visibility and agility in supply chain management. Understanding customers is key to success in emerging markets. Data analytics and market research help companies identify trends, preferences, and unmet needs. Investing in local research teams and leveraging digital tools can provide valuable insights. Companies that act on these insights can tailor their offerings and marketing for maximum impact. Scaling operations in emerging markets requires careful planning and investment. Companies must balance rapid expansion with quality control and risk management. Building scalable processes, investing in technology, and developing local leadership are critical for sustainable growth. Successful scaling also involves adapting to changing market conditions and customer needs. Having a clear exit strategy is important when investing in emerging markets. Market conditions can change rapidly, and companies may need to divest or restructure operations. Planning for different scenarios such as mergers, acquisitions, or public listings helps protect investments and maximize returns. Flexibility and foresight are essential for managing exits effectively. Learning from successful companies can provide valuable guidance for entering emerging markets. Many global brands have thrived by adapting to local conditions, investing in relationships, and innovating for unique challenges. Case studies highlight the importance of patience, persistence, and local engagement. Let's draw inspiration from these success stories as we shape our own strategies. Summary: emerging markets offer tremendous opportunities for growth, innovation, and impact. However, success requires a nuanced understanding of local conditions, a willingness to adapt, and robust risk management. By building strong partnerships, investing in talent, and staying agile, companies can unlock the full potential of these dynamic economies. As the global landscape evolves, those who embrace emerging market strategies will be well positioned for the future.